Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show, and I thought I'd start today by asking a simple question, that is the IRS after you? Well, that's a question I do get sometimes in my practice, but it's something I thought I'd spend a little time talking about. And specifically what I want to talk about today is the 4 tax penalties to avoid at all costs. Now, there is a author that writes for the Motley Fool named Maury Beckham, and this article was published on the 13th of March. And in this article, there's laid out of the 4 tax penalties to avoid. And I thought these were really very good things to talk about. So let's talk about those. First one is the early retirement plan withdrawal penalty. Now, this is a penalty that I see routinely throughout tax season. And most people don't realize that it's a penalty because they just assume, well, this is just the way it is. And what we're talking about here is if you've got money in a retirement plan, such as a 401k or an IRA or some sort of, traditional type of retirement plan that is done with pre-tax money, you are not able to access and use those funds until you turn 59 and a half. If you do happen to use those funds, there's a 10% penalty based on the amount that you distribute. So let's say, for example, you get into a financial bind and you need to take $10,000 out of your IRA. Well, you're going to have to pay not only federal and state income tax on that, but you're also going to pay a $1,000 penalty or 10% of the withdrawal. And what most people don't realize is that is in addition to the taxes. So a lot of times clients will come in and say, well, I had to take some money out of my 401k, Ralph, but I went ahead and had them take the taxes out. And what that normally means, in client speak, is that they had them take 20% in tax. Well, the problem with that is, you've got that 10% penalty, but if you've got other earned income, it may very well be the case that you're in the 15% or, somewhere in the 20% tax rates. And so that 20% tax isn't going to be enough to cover everything, because this is both at the federal and the state level. So just something to keep in mind. And while we're talking about that, this goes along with any 401k loans you may have taken while you're working as well. If you lose your job, whether it's no fault of your own or the company closes or something like that, and you have money owed on your 401k loans, then those loans become distributions effectively in 60 days after you stop your employment. So you have 60 days to pay those back, or they become a early distribution, again, subject to that 10% penalty. So let's try to avoid the early retirement plan withdrawal penalty. Going along with that, and I would say at the other end of the spectrum, is the RMD penalty. Now, what is the RMD? It's a fancy way of saying required minimum distribution penalty. And what this means is that when you turn 70 and a half, and more specifically, your first RMD must be taken by April 1st of the year following the calendar year in which you turn 70 and a half. So this is an example. It means if you turn 70 in May of this year, you'll need to take your first RMD by April of next year. And then all subsequent RMDs are then due by the last day of the calendar year. Now, what's the big deal here? Well, the big deal is if you don't take your money out at 70 and a half, and your broker or whoever is doing this investment for you will give you a chart of what the required minimum distributions are, the penalty is 50% of whatever you neglected to remove. So let's use that same $10,000 example. If your RMD is equal to $10,000 and you fail to make that RMD distribution, you're going to pay a 50% penalty or $5,000. So it's very important, if you've got any type of IRAs or any type of investments, that you make sure you're talking with your broker or the investment people and make sure you've got those RMDs set up, because this is a huge cut, a big tax that you're going to pay if you don't make those RMDs. And a lot of times I see this if people have multiple investment accounts. You have to take them from each and every one of those accounts. So it's something you want to definitely talk to your broker or your bank, whoever's handling your retirement accounts for you. Now, The next two, or the last two in this discussion, are really the two that involve individual taxpayers. And that is the first one, the failure to file penalty, and lastly, the late payment penalty. Now, it's getting closer to the end of the tax season filing this year. So we've got a lot of clients that we're looking to say to them, hey, are you going to file an extension? Because the tax deadline is April 17th. Now, every year, a lot of people just simply neglect to file their tax returns. And why is that a problem? Well, it's a problem because the IRS will hit you with a failure to file penalty equaling 5% of your unpaid tax bill per month, or partial month if you're late. If you let it go on too long, you could rack up a penalty of 25% of your unpaid tax bill. Again, this is a huge penalty, and this is something that can be completely avoided by simply filing an extension. So if you know you're not going to have your taxes done or ready to be done for somebody like myself or an accountant, or a tax preparer, you definitely want to contact us or contact, someone or do it online yourself and file an extension, because then you will avoid the failure to file penalty, which can save you 5% of your unpaid tax bill per month, or 25% of the total tax bill. So why pay this penalty when all you need to do is ask for an extension? Now, a lot of times this next penalty go hand in hand, and I get a lot of pushback from clients on this. Now, just because you file an extension doesn't mean that you have an extension to pay. So you've got an extension to file, which will save you on that failure to file penalty, but that does not give you an extension to pay. The taxes are due when the taxes are due, and the tax payment is due when the taxes are due, not based on the extended day. So if your taxes are due April 17th, then you need to pay by April 17th. And I know what you're thinking. Well, Ralph, okay, well, how am I going to know how much to pay if I haven't even filed and I filed an extension to file? Well, I don't know what to tell you, other than what you're going to have to do is send in an estimated payment, or just accept that you're going to pay a late payment penalty. Now, the late payment penalty is equal to 0.5% per month, or partial month that the bill remains unpaid, up to a total of 25% again. Your maximum penalty can't exceed 5% per month, but that's still a lot of money to lose. So, point of work here is that, number one, don't miss out on filing an extension if you're not going to be able to get your returns done on time. Secondarily, if you have an inkling or you have an expectation of how much you're going to owe, then you may want to make that payment when we file your extension, or when you file your extension. There's a part on that form, so that even if you get money back, and this is a little secret a lot of people don't know about, if you get money back, the IRS is going to pay you interest. Yeah, I did say that, interest. A lot of clients are surprised by that. They will pay you interest if you overpaid them and then you file after the fact because you were on extension. But they will definitely charge you a penalty and interest if you don't pay by the filing deadline. So, like I said, make sure you are filing an extension if you need to avoid the failure to file penalty. And let's look at trying to get those taxes paid to avoid the late payment penalty. So I hope this was really helpful on the things to avoid IRS penalties.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.